Hey everyone, Michael here. So in this video, I want to walk you through Walmart and specifically show you what insights I'm learning from looking at the company report. Now, this is the first time I'm looking at the stock, but I just want to show you how I got here first. So I was on the screener and I basically just made a very simple filter. I just wanted to show or to find any companies that had scored 5 out of 6 on the dividend and had a market cap of more than $1 billion. And so when I put that filter in, I was shown 428 stocks and I found Walmart here. So just wanted to show you how I got there. Now that I'm on the company report when it loads, I'll show you what I look at first. So first thing I check out is the snowflake, and I already saw it on the screener, but I'll just give you a summary of what I'm seeing. So straight away, I can see that it does pretty well in dividend, scoring 5 out of 6, or very well in dividend, scoring 5 out of 6. But in terms of value, future, and past, it doesn't perform very well at all. So it doesn't seem to be an undervalued company in some metrics. It doesn't seem to have the best future prospects, and it doesn't have the best track record, but it's got a relatively solid balance sheet. So as this snowflake analysis summary tells me here, it's like an established dividend pay with an adequate balance sheet. So straight away, bit of insight there, good to know, and I'll have to keep an eye on those three metrics, specifically value, future, and past, and see if there's like any concerning signs there. So I know that the company is in a retailer. It's a massive wholesaler and has huge operations worldwide. But given that I don't live in America, I don't use the product daily, so I'm not the most familiar with it. And this is just me running through the company report as if like I haven't had the most research done on the qualitative side of things. But this will show you what you can look at when like you're first looking at a company and you're not too familiar with it, and if it's a company that you want to look into further. So the next thing I look at is the risks and rewards. And I can see here straight away that according to Simply Wall Street's valuation, its estimate of fair valuation, the company is trading at roughly a 19% discount to its estimate. So that's interesting. I'll have a look at the calculations when I get lower down, but that's something to keep in mind. It also says the earnings are forecast to grow 9% per year. So that's actually pretty decent growth. I'm wondering why it doesn't pass too well in the future check, but I'll get to that in a second. And it says it pays a reliable dividend of 1.46%. So that's not the highest yield, but reliable meaning like it's obviously hasn't like cut dividends in the past, so it scores well there. So I'll look more into the dividend when I get to that section. As for the risks, it's got a bit more. So it has a high level of debt. When I get there into the financial health section, I'll have a look if it's affordable or not. It has large one-off items impacting the financial results. That's interesting. So maybe huge one-off expenses that are causing its earnings to decline this year in the past. Profit margins are lower than last year. That might be because of this large one-off item. And significant insider selling over the past 3 months. So I'll want to have a look into why those insiders were selling, and I can do that in more detail later on. Now the next bit I look at is the competitors. So even though I've clicked Walmart here, there may be better opportunities out there. And so I have a quick look at their snowflakes. So I can see Costco, PriceSmart, Amazon, and even Berkshire is here considered a competitor. And we've got, although these snowflakes look good, they're good in different respects. So Costco and Amazon, for example, don't score well at all in the dividend. And that makes sense why they didn't pop up on my original screener, because I was looking for a high dividend, like 5 out of 6 score. So considering I'm looking for a dividend stock, I actually won't look at these two, even though they do seem to both have, Costco has good health and an amazing track record and okay future prospects, and Amazon has a moderate health, good track record, and amazing future prospects, or good future prospects. PriceSmart actually might be the other one I look at. So it scores 4 out of 6 by the looks of it in the dividend section and has very good health and a decent track record. So I'll go have a look at PriceSmart, considering it's the only other dividend competitor, I suppose. So I'll keep that in mind when I get to the end of the company report to go and have a look at that company's report as well. Next bit I look at is the price history and performance. So it looks like the stock's been pretty flat over the past year, but I just want to clarify that I don't use share price movements as like an indicator of whether to buy or sell. Rather, with our investing style, like based on narrative-based investing, we pretty much use the underlying developments of the business that change and update our narrative as to whether or not a company is like meeting our thesis or not meeting our thesis. So here, what I use this section for is basically, as you can see, there's a whole bunch of events that are occurring, like it shows you dividend, financial management, strategy, and other. And what I'll do is to try and get some context about the share price movements rather than just looking at the chart itself and trying to decipher that, which isn't very useful. What I'll do is I'll look at the actual underlying developments and see what's occurring. So Walmart selects Transparent to provide go-to-market solution for self-insured employees. So updates like this, I'll read through them and try and get an idea of the underlying developments in the business and see how that is actually treated, or how that has resulted in like share price movements. And also, I use this section to kind of get an idea of what projects or like the updates they're announcing, what projects they're working on now that could have a big impact later on. So product announcements or plans of future growth and new initiatives they're working on. So this will help me get some color around the business and help add to my narrative that I'm trying to build. And so obviously if I want to go further, I'll look at the 3-year performance, and I'll do the same thing and read these developments that were occurring back here and see actually like if they have played out and if they've played out well, or if there's stuff that's like they're still working on that hasn't actually come to fruition. So I'll just basically look at that and get some more color. And this next part's very similar. So I'll be using the recent news and updates section, and I basically look at this when I want to get more color about the underlying business as well. So this here is a collation of all the articles written by our internal news team, and also any updates that we provide that are more short form, like insider selling, for an example. And we also have a partnership with Seeking Alpha where we surface some articles written by the authors there. Now, I just keep in mind that these are obviously people's opinions, but it's very useful to look at because ultimately, if I have like looking at a company through rose-colored glasses that I just think it's great, there might be some people out there who are covering the stock and have a much more bearish opinion. So it's really interesting to read why they think that is. So this person, still not my preferred retail company, and I'll read through. This is a great summary here that I can get a high-level overview of what they talk about. And if I have a subscription, I can go through and read the whole article on Seeking Alpha. But yeah, so when I finish the company report, I'll go and read through more of this news and try and just continue to add more context and color to that narrative that I'm trying to build. Next bit I look at is shareholder returns. So as I saw, the company's actually been pretty flat over the past year. It's underperformed the US consumer retailing section, and that might just be because it's such a huge retailer and there's smaller players out there that have performed better. And even compared to the US market, it's performed, the US market has performed even better than that. So the market's just been on a tear, and this company's been pretty flat. So it's probably maybe just because it's like a huge company and doesn't have as higher growth prospects as some of these other companies do. So just something to keep in mind. And it's not very volatile at all. It's a very stable business. It's even more stable than the industry and much, much more stable than the market. So just something to keep in mind if I'm looking for like a defensive stock. And a bit more details about the company is the next bit that I would look at. Now, if I was completely unfamiliar with the company, I would read through this to see exactly what it does and just get an idea of the business as a whole. So I'm relatively familiar with it, so I won't read through that here, but if I wasn't, I would. The next bit I look at is the Walmart fundamentals. So this is a great summary just showing me the key metrics. So market cap, earnings, and revenue, and then it shows me the metrics here of price to earnings ratio and the price to sales ratio. Interestingly, it's a $418 billion company in terms of market cap or its valuation, and it actually earns revenue of $566 billion, which is crazy because it's trading at less than its sales. Now I can see here that it must have, and I think I'm about to learn that in a second, it has incredibly slim margins because it only earns $10 billion from $566 billion worth of revenue, which is just crazy slim margins. So it means they run like a very, very tight ship. Price to earnings ratio of 41. That's a relatively high PE ratio, but I actually don't have any context. Well, I sort of do. I have context about the future earnings growth being 9% per year is what's expected. So given that price to earnings ratio and the expected earnings growth of like 9% per year, it seems a bit elevated, which is why it maybe doesn't do too well in the value section, but I'll get more context on that soon. And again, the price to sales ratio doesn't mean too much to me in this case because it is a profitable company. So yeah, it's not hugely meaningful to me here, but it's useful if I'm looking at a non-profitable company, and it helps me compare non-profitable companies against each other. Now, the next part I look at here is the earnings and revenue breakdown, which also includes the costs. And so as we saw above, I can see here that there's $566 billion in revenue, but in order to generate that revenue, there's cost of sales of about $424 billion. And that's things, and that expense there is them buying things like the underlying cost of the product that they end up selling in their stores, and like the distribution between the different warehouses. So while it's a huge amount of revenue, $566 billion, it costs an incredible amount of money to generate that revenue because they have such slim margins, and that shows me, that they have such slim margins. So that gives them a gross profit of about $142 billion, and I can see here their expenses are $132 billion. So this is stuff like research and development, general and admin, just basically costs that aren't involved around incurring the revenue, or earning the revenue, stuff that they spend after that they've done that. So yeah, employee expenses and stuff like that. So they're running an incredibly tight ship where they have really slim margins because that only leaves them with an earnings of $10 billion. And so I can see here that they have gross margins of 25%, which isn't too high, but they have net margins of 1.7%, which is incredibly slim. So they haven't really got much room for error. If for whatever reason their cost of revenue was to go up, like say the product's underlying cost because of inflation were to go up, or that their wages were to go up for their employees, and I saw before they have 2.3 million, that could be a big issue because they have such slim margins. Any sort of increase in these expenses could hurt the bottom line. So that's something I'll keep in mind. And debt to equity ratio, like I saw the warning above, it has a 48% debt to equity ratio. So I'll check out if the debt is affordable or not. But either way, that's a pretty high level. And the next part of this summary is just the dividend. So as we saw, it has a dividend yield of 1.5%, payout ratio of 61%. That's pretty high. And I wonder if that's related to the one-off earnings impact that we saw, the risk above. So that might actually just be temporary. So I'll check that out later. And I just get an indication of if I do want the dividend on the next one at least, what day I have to buy it before. So here it tells me today is November 9th. I have to buy it before December 9th. So I have 30 days to receive the upcoming dividend, which is going to be paid on the 3rd of January. So good to know, since I'm considering it as a dividend stock, that's the information I want to keep in mind. But you can't just look at the yield and those sort of details. I've got to look at everything else. So the next part I look at is the valuation, and this is simply Wall Street's estimate of fair value. And like we saw above, it doesn't pass many of the checks. This is really the only one it passes here, is that it's beneath simply Wall Street's estimate of fair value, which is $185, and it's currently trading about $150. So to get some more color on that, I'll have a look at this data here, which shows me how the calculation was done. And it was calculated using a two-stage free cash flow to equity model. And here's all the inputs I can get, estimates from 24 analysts, the perpetual growth rate, the discount rate, and basically while I'm looking at all this here, if I disagree with it, what I can go do is go into an Excel spreadsheet or something and build my own model and change the numbers slightly depending on the inputs that I think are necessary. So as I get more color and insight into the company, like I understand its underlying business and what I think is a fair discount rate, I can then sort of calculate those sort of numbers, and in my own model I can then play around with these. If I don't agree with these here, I can then go around and play with them and see how the valuation changes depending on different inputs. So if I used a higher discount rate, the valuation would be much lower than what it says here on the Simply Wall Street thing. If I used a lower discount rate, then it would be a higher valuation. So, but I have to have an underlying reason as to why I would change these numbers. And what I think is fair. And then so if I just want to get more color as well, I can look at this data here and I'll read through that in further detail as I get deeper into it after the video. So I can see here, while it's below Simply Wall Street's estimate of fair value, it's not significantly below. Like the margin here is 20% and it's almost there at 19.2. So potentially undervalued based on analyst estimates of the free cash flow that it's going to generate in the future. The next thing I look at is the price to earnings ratio. So it's apparently poor value because it's trading much higher than its industry. I can see here industry is in the US consumer retailing is about 21 times earnings, and the market is 18.5 times earnings. So it's trading at 41, which is much higher, and considering it has earnings growth expectations of like 9% per year, I'm going to look at in just a second in the future section what the growth expectations are for the industry and the market, because that will provide me more context as to if the current valuation is fair or not, or if there's any reason why it might be trading at a premium to its peers. So the next is the price to earnings growth ratio. This one isn't too insightful, but it shows me kind of like how the price relates to its expected growth. And according to this metric, it's not good value, but this one isn't too meaningful to me. Next is the price to book ratio, and I usually only look at this if I'm looking at industrials and financial stocks because they generate a lot of their earnings off their asset base to generate. They use their asset base to generate their profits, and so this company here, while it's 5.2, so it's a relatively good ratio, it's not as good as the industry or the market. So again, not too meaningful. It's not the primary thing I look at, so it's not a deal breaker. Now, the next section I look at is future growth, because ultimately future growth is very important. It relates very highly to valuation. Like, it gives context as to whether today's valuation is fair or not, because if it has really high expectations, then a higher valuation today might make sense. So what I'm looking at here is I can see it only passes one of the 6 checks, and I'm about to find out why. So there's 24 analysts who cover the stock, expected to have 9.2% annual earnings growth, which is pretty decent. Like, I'm surprised by that considering how big the company is. And I can see here the visual representation again of how slim the margins are. So look at that, the $566 billion in revenue generates $10.05 billion in earnings, which is crazy slim margins. I'll have a look at free cash flow and cash flow from operations as well, because these are important metrics. Ultimately, like the discounted cash flow models use the cash flow figure, because sometimes earnings aren't a representative of cash flow. They have certain non-cash expenses in there, like depreciation. So it's just something to keep in mind. But cash flow isn't impacted by items like that. So very interesting, like cash flow from operations being 29 billion, so it's almost 3 times as high, and free cash flow being 17 billion. So it looks like there's been a dip over the last year, considering earnings were 13 billion at the start of the year, 19 billion last year, 17. Okay, so this one-off item might just be temporary, and it looks like, according to the future forecast, that analysts, like we saw, do expect earnings to recover, like 15 billion next year by January. This is for trailing 12 months, by the way, so this isn't like quarterly figures. This is for the 12 months leading up to January 31, 2022. So yeah, interesting. Looks like they do expect earnings to recover, so it looks like it is just a large one-off item. And if I wanted to get more data or more insight into the figures that they've got in here, I can have a look specifically at all the individual numbers. And I just got to keep in mind, this is the analysts' average estimates. Some analysts may have higher expectations, some may have lower, but this is the average provided in this chart. So the next thing I look at here is the growth forecast for the company, market, and industry. And this provides me context to what I saw above in the valuation section, which was the company, industry, and market PE ratios. So we saw the company was trading at a PE ratio of like 41 times earnings, and the industry, I think, was 21, if I'm not mistaken. So it's interesting how high the company is trading, considering it doesn't even have as high earnings growth expectations as the industry. And even more interesting is that the market has an even lower PE ratio, but it has the highest earnings growth out of all of them. So that might tell me, by looking at that right here, I'm like, if I want a high growth company, it's typically not this one I'm looking at. Not only does it seem a bit overvalued considering the price to earnings ratio and its growth forecast, it's not even as good as the industry. So there might be better consumer retailing stocks out there that I could look at that have a higher expected earnings growth. And compared to the US market as a whole, there's even better earnings growth opportunities. So if I was looking for earnings growth, then that is what I would do. I would go to the screener and I'd filter for the US market, or I'd filter for consumer retailing, and anything above like 10% earnings growth is what I would look for. But in this case, I'm looking for dividends. So this isn't a huge deal breaker. I just know that it's a low growth company. But if I was looking for higher growth, that's what I'd do. Similar situation with the revenue as well. It doesn't expect to have a very high growth on top line. Industry seems better, and the market seems even better. So again, this confirms, and these checks here basically just confirm what I just said. It passes like the minimum bear threshold of the savings rate, which is what you could earn typically from like a low risk government bond, although that changes. Walmart doesn't do anywhere near as well in the future growth section, so it's not a growth company. Earnings per share growth forecast. This is the next part I look at, and this seems to be shedding some light on the one-off item. I think I'll learn about it soon. But the earnings per share have declined considerably over the past year. So they were $6.96 last year in October 31, and for July 31 just gone, they were $3.56. So I'm going to have a look at what happened. I'm going to have a look at what happened to see what caused this huge earnings decline. But regardless, I can see here that even though it has had a huge earnings decline, analysts don't think it's long-term. They think it's a temporary, short-term thing, because I can see here that already by the start of next year and going into the next couple of years, they expect earnings to recover significantly. So that's a promising sign. It's just like a one-off thing. That's maybe helping explain why it's trading at a higher multiple than typical, because the investors as a market as a whole might be thinking, yep, we're happy to pay a higher premium now, like a PE ratio, because this earnings that it's based off are only temporary. If they recover back up to here, then that PE ratio all of a sudden gets much, much lower. Like if it doubles, as we see here, $3.56 to $6.51, then yeah, all of a sudden the PE ratio drops considerably if it's trading at the same price it is now. So it seems like the market already expects earnings to recover as well. Future return on equity, just basically I look at this to see if they still are going to be able to allocate shareholders' money well in the future. And it looks like they will. 20% is the threshold of what's considered good. And so it's 19.8. It's just underneath that threshold of being good. But yeah, compared to the industry, it's doing better. And in the future, it's expected to have good return on equity. So good to know that they have some sort of prospects in the future. This is from analysts who do submit forecasts. So good to know that like they'll have prospects in the future or initiatives in the future that they can continue to invest in profitably. Now, the next section I look at is past performance, and this is basically just to tell me if the company has a track record, and if it does, then that can help me try and model what might happen in the future. Obviously, past performance is not an indicator of future performance, but it just helps give me a bit more like certainty, I suppose, about like reliability and like a track record to base things off. So it doesn't seem like Walmart has that. It only passes one of the 6 checks, and its earnings growth has been incredibly low. But again, I think that's because the one-off item that we're about to find out about may have impacted significantly. Yeah, so if this one-off item didn't happen over the past year, then earnings might actually be considerably higher, and that earnings growth might be better. But yeah, from what I can see, it's had a big impact. Now, I typically, when I look at this graph as well, I put over the past operating expenses, and this just shows me if it's allowed net margins to increase or not. And as we can see here, the 2 checks that it doesn't pass for its past performance is the large one-off item that we were talking about is $11.2 billion, and that's impacting its results for the year to July 31, 2021. So that's what we can see there. It seems like a one-off decline, and if we don't include that one-off decline, I'm going to go find out what it is for starters. I'll go look at the company reports and try and find out what this huge expense was. And obviously, as everyone seems to expect, it's not permanent. It's just a one-off. But that tells me that in a normal situation without that, it would be closer to 20 billion. So that's encouraging. But also what that impacts is these profit margins. So we can see here that they were higher last year, being 3.3%, and now they're only 1.8%. So even though operating expenses have been pretty stable and revenue has actually been growing, because of that one-off item, I can see that it really did impact net margins. So it doesn't pass these 2 checks here, which is a shame. But if I take into account what I saw in the future section, it tells me that this is predicted to just be temporary. So not a huge issue, but still, doesn't pass that check. So that, looking at future, gave me context about that. Next section I look at is just the same sort of comparison, but it's for the past earnings growth, and rather than the what we saw above, which was the future. So as we saw, had very low growth, but it probably contributes from that one-off item this past year. Industry's been performing better, and the market's been performing better. And this last 1 year earnings growth, because that's the past 5 years, this last 1 year has been a negative 43% decline thanks to that one-off item. So this, while it seems bad, I have context as to why it's happened, and it seems just temporary. So the industry and market have done much, much better, but yeah, it's still just interesting to know that that one-off item has had a big impact. So this is what we saw. It doesn't pass these growth checks, and it's actually had negative earnings growth, so it doesn't pass these past performance checks, but I have context as to why it doesn't. And as we saw further up in the report, we saw return on equity expected to be in the future, and here is just what return on equity is right now. And it's actually much lower than the future return on equity. And again, that could just be because of that one-off item. It's impacted the returns that they generated this year, so they're potentially much lower than they usually are. Now, it's much closer to the industry, so at least it's not underperforming. But if we get back to a stage like with next couple of quarters when the earnings recover, then I expect this return on equity to improve and potentially go back to closer to 20% or whatever it was before the one-off item. So that's just interesting to know. Next, what I'll look at is these return on assets and return on capital employed. So it's roughly in line with the industry, which is good to know, like it's not underperforming. That's the main thing I look at here. And the return on capital employed basically just takes into, it's basically assets minus current liabilities, and that allows it to take into account debt as well. So it actually is outperforming the industry here as well, and it's almost generating like a good return, being 20%. 18 is pretty solid, but it's good to know that it's improving from what it was 3 years ago. So promising signs. Now the next step I look at is financial health, and this basically is important because since I'm looking at a dividend payer, I want to know, is the company highly leveraged, and if so, like does it have any obligations that could really impact its ability to pay its dividend? So it's very important if I'm looking at a dividend stock to know that it has a solid balance sheet, because if it doesn't, then there's a risk that the dividend could be cut when like they have financial troubles of like debts being due and stuff like that. So it says it passes 4 of the 6 checks here, which is good to know. And to get some more color on it, these are the checks. So it has short-term assets of 78 billion, but it has short-term liabilities of 81 billion. So short-term assets don't cover them. So unfortunately, that means that if all these liabilities, for whatever reason, black swan event, if all these liabilities were to come due, then it doesn't actually have short-term assets high enough to pay all of them. It's only just shy, so it probably could raise some capital or something if it really needed to, or debt. But if these short-term liabilities, which is things like accounts payable and suppliers and stuff like that, if it had to pay them, it wouldn't be able to. So it's just shy, which is a bit concerning, but not huge. However, the long-term assets are like much less liquid, and they've got heaps, but they won't actually, these aren't that easy to sell. So the other check that I see here on the report here is it checks the company's short-term assets, being cash and cash equivalents and stuff that's very liquid and easy to sell. Can it cover the long-term liabilities? And in this case, yes, it can. So that's great to see that if for whatever reason these long-term liabilities came due, which is things like maybe the rental agreements and stuff like that, they could pay them if they had to with their short-term assets. So that's good to know. It passes that check. And the next part I look at is the debt to equity history. And this basically is important because I want to see how the company utilizes debt in its capital structure. And so I can see they've been pretty steady with their equity over the period of 5 years. And that's basically just like their retained earnings and the share price as well. And what we can see here is the debt actually, while it was reducing for a bit, they then decided to take on some more in 2018, and they've started to reduce that debt a bit there. And promisingly, the cash balance has actually been increasing, but it's still a pretty high debt ratio. So we can see from the checks here, it's actually 48% of equity, which is actually considered high. Anything above 40 is considered high. So that's a bit concerning. It's using a fair bit of debt in its capital structure to finance its operations. And the good news is, though, that it's been reducing like we saw over the past 5 years. Now, as for the debt's affordability, it actually passes these checks. So it's operating cash flow, that it's like the cash flow that it generates from its core business. It can cover the debt pretty well. So that's good to see that, like, if worse came to worse, its general core business could cover, had a fair bit of coverage of the debt. So not completely, like only 69%, so it couldn't cover it off in 1 year. But in less than 2 years, the company could pay all of its debt. And the interest coverage, this just tells me how well it can afford the interest payments. And it seems like it can cover the interest payments by 14 times, or more than 14 times, with its earnings before interest and tax, which is basically, it's in the name. It's the earnings that the company generates before it pays interest and taxes. And so, yeah, it has plenty of coverage there. Anything above 3 we consider good. So it's good to see that it can service the debt well. Now, next thing is just more of a visual representation, and the key thing I look for here is basically the cash and short-term equivalents related to some of these debts. So this shows you the balance sheet with assets and liabilities and equity, and they always balance up, just so you know. But the cash and short-term equivalents is typically what I keep an eye out for, and I also look at the debt. So I can see here that, like we saw, it has 42 billion in debt and 22 billion in cash and equivalents. So it would have to rely on receivables of, I see there 6 billion and inventory of 47 billion. So these things are probably easier to liquidate and generate into cash if it needed to pay all of this debt and that was due. But just something I keep in mind. So it passes the other checks above, and this just gives me a more visual representation of it. So the more important part now that I have all of that context is the dividend. And I want to see, since I'm looking at the stock for the dividend, I want to see if it's reliable, if it's not like too strenuous for the company to pay a dividend, being like a high payout ratio, and if there's actually any growth prospects that means the dividend could like improve. So it does pretty well here. It passes 5 of the 6 checks, and I'm going to get some more color on it now. So like we saw, it's only like a 1.4% yield, which isn't huge, but apparently it's reliable. So that's good. As we saw above, the ex-dividend date is December 9, so I've got about 30 days to decide if I want to buy it. And then the dividend will be paid on the 3rd of January. Now, I compare it to the yields versus the market and the industry average, and it's it's not the highest. We can see the the top 25% the dividend pays in the US have a yield of about 3.4%, which is much better, more than double. But it surpasses the bottom dividend payers, which is like 1.3%. So it's all right. It's not a huge yield, but it's good. It's roughly in line with the average of the industry, the consumer retailing industry, and in the 3 years, it's forecast to be about 1.6% yield. So not huge growth, and that's based on the current price, right? Because you can't forecast what the share price will be. It's based off what they think the yield would be in that future. So not huge growth in the dividend, but a little bit at least. So the next part I look at is the stability and growth of payments. So it's important to look here how the company's yield has been tracking, because this blue line here is the yield based on the share price, right? So, and it's a yearly average, right? So if I was to look at it there, if I was to buy it in 2016, it was paying me a 2.9% yield based on the share price at that time. Now, obviously, the share price has increased since 2016. That's why the yield, this blue line, has gone down so much, because even though dividends have increased, the share price has increased a lot more. So the yield that you're getting has reduced. Like it was, I can't remember the share price exactly, but it wasn't $150 back in 2016, and now it roughly is. So it would have been a much cheaper price, meaning the yield was higher. However, the underlying payments, being the dividends that we're receiving, have been consistently increasing, which is great to see here. So they were $1.46 back in 2011, and we can see here that they've just been gradually increasing year after year after year to where we are today at $2.20. Which is great to see. And analysts' forecast for the dividend are actually expected to continue increasing to the end of January 2024. So there is growth expected in the dividend, and even though the yield has decreased, that's purely because of the share price appreciation. So just something to keep in mind. And the earnings per share here tells me, now another thing, this purple line, you may think, oh wow, they're paying dividends higher than their earnings per share, what the hell? But if you look at this, I'll put it here. So the dividend per share being $2, is actually different to the earnings per share. So it's a different scale, right? It may look a bit confusing, but that's just something to keep in mind. So the earnings per share were actually $4.53. So the dividend in that period was almost like less than half of the actual underlying earnings per share. So it's not, it may look confusing, but it's not actually paying more than it's earning. It's just a different scale for the earnings per share chart, because it needs to show you the different measurements. Otherwise, this chart would look a bit weird. So yeah, it seems to have always been able to cover, because the dividend's never gone really above $2.20. Its earnings back in late 2019 had a short period of underperformance, but it continued to pay the dividend. So maybe it took out or just paid some of its cash balance out as a dividend. So yeah, that's interesting and good to keep in mind. So the dividend has been stable over the past 10 years, and it's been increasing over the past 10 years, which is great to see. Now, this is important. So I want to look at, for the company earning $10 billion, like how much of that are they paying out? And here it looks like as the current earnings are $10 billion, they have a payout ratio of about 61%. So it's good to see that they're covered by earnings, but 61% is a pretty high payout ratio. But again, that's probably because of that one-off item that we saw above. So if that one-off item hadn't happened, the dividend ratio, the payout ratio would probably be a lot lower. And as we saw, analysts expect earnings to improve and recover. So that's why they expect the dividend to be back to a payout ratio of like 35% in 2024. So that's a much better payout ratio, meaning that they'll keep about 65% of their earnings. And that tells me that with that 65%, they can then allocate that capital to reinvesting in the business, or holding on to it for like future projects, or doing buybacks, or whatever they choose to do. So a 35% payout ratio is really good. 61% is pretty high, but this is just temporary from what I saw above. So that's good to know. Now, the next part I look at is management. So basically what I want to look at here is management aligned with shareholders, and is management experienced at the business that they're in, and has management been doing any actions that I should be concerned about that may impact their decision making? So like, have they been like selling any shares, for example, that could make me concerned to be like, oh, why are they selling if they believe in the company? So that's what I look at in this section here. And basically the first part it shows me is tenure, is how long everyone has been there in the business, and then the average management tenure is about 3.4 years, and that's pretty good. Like that shows me that there isn't a high staff turnover, which is great. So everyone's been there for a few years, and it's not like everyone's jumping ship quickly. So that's good to know. This is the CEO at the moment, and he's been there for 7.75 years, so almost 8. and he's compensated $22 million. So that's quite a high compensation. And what I'll do is I want to get more, I want to know more of the background about the CEO. So when I'm looking at a business to invest in, I'll read, just like I would with the company details above. If I didn't know it, I would read more about the CEO here and get sort of more color on his experience. So I can see here already, even though he's been the CEO role for almost 8 years, he's actually served as the executive vice president of Walmart since 2005. So he's actually got a much longer tenure within the business, which is great. Shows me that he's got a lot of experience within the business, which is great to see. And then so what I would do is I'd read more about his bio here, and you can get a lot of details here to show you who the person is that's actually managing your money, or your shares, and allocating money into different projects. So it's good to know like what their experience is, where they have expertise or not. So yeah, this is an interesting part to read. And so this next part I look at is basically showing me whether he is compensated in alignment with shareholders or not. So like if the underlying company performance is good, and he's compensated accordingly, or if he's compensating very generously regardless of company performance. So the checks here tell me that he's actually compensated well above what companies in the US market of a similar size get compensated, which is about 10 million. He gets compensated 22 million, but it shows me that his compensation has been consistent with company performance over the past year. So we can see here that he's actually paid a salary of 1.2 million, but his total compensation, which includes things like cash, bonuses, and stock options and stuff, is closer to 22 million. And interestingly, it seems like there was a period here over 2016 to 2019 when earnings the company's earnings declined a fair bit. Like we can see 15 billion versus 5. So he was still paid the same amount. So that's interesting. That tells me either A, he's got different performance metrics that he's actually being compensated by, which could be concerning. Like ultimately we benefit if company earnings grow. So he's being compensated regardless. I'll want to have a look into why. So I can go and read the annual report, look at the compensation section and see what his performance metrics are and what he's trying to strive to achieve. So it could be like store openings. It could be cutting costs. I don't know. So I'll go and try and look into why, what he has to do to get his stock options and cash bonuses, because it looks like it doesn't really align with company earnings. So that's something I'll try and get some more color on. Next is the breakdown I was telling you about of the alignment with shareholders. And so what I look at here is basically everyone in the leadership team. Just like we saw the profile for the CEO above, I can now look at this for every other person in the business. So this is for the CEO. Again, I've got his bio there, but I can read this for every other person in the company, and I can see their position and their tenure, like how long they've been there. Seems like they've all been there for at least a few years, or most of them. But what I also look for here is their alignment. So how much ownership do they have in the stock? Because ultimately, if they own a lot of the stock, then they're very aligned with shareholders, because ultimately, if shareholders benefit, they benefit. So then it's in their best interest to do the right thing by shareholders. And I can see here that they all have like at least a couple of plenty of millions of dollars invested in the stock. So that straight away is a good sign for me. It shows me that they're quite aligned for those that we have data for. And it shows me that they would be aligned with shareholders. So that's a big tick for me. And this check here shows me that, yes, like we saw above, their experience, anything above 2 years is considered an experienced tenure. So yeah, it's good to see that they all hang around for at least a few years. And this next here is the board members. So the board members ultimately like dictate what the internal management team does, and they're like the highest level. And so again, I can look at all their profiles and learn more about them and where they've been and what their experience is. I can see here their tenure in the roles that they're in, and it looks like they've all been here for a few years, which is great to see. As for compensation, that's pretty high compensation for board members, but it's a big company, so that might be the reason why. And then the most important thing I check is ownership. So are they all aligned with shareholders? And I can see here that, again, it looks like most of them have millions of dollars invested, except for this person, that most of them have a lot of alignment with shareholders. Like they've all got a lot of skin in the game, money on the line. If shareholders were to lose out, so would they. So they're incentivized to do the right thing. And yeah, the average tenure for the board members is experience. So it's over 5.9 years, which is great to see. Now, the next part I check is ownership. And this is similar to what I was mentioning before. It's the insider buying and selling and what the shareholder registry is made up of. So we can see here that actually it seems like there's been a lot of selling from insiders. 2 individuals here, 1 company, 6 individuals, 1 company, 1 individual, 1 company, for values of like 1.2 billion, 4.7, 269 million, 1.4 billion. So that's a lot of selling and not much buying. So straight away looking at that, I'm like, okay, that's a bit of a red flag. Why has there been so much selling? But it's not a strong indicator of being like, holy crap, get out. I want to actually look at why they may. I want to dig deeper as to why they may have been selling. So obviously it doesn't tick that box. Insiders have been selling in the past 3 months. So what I'll look at here is the particular trades that were displayed above, and what I can then do is go to the company report. Go to the company's investor relations section, and I can then actually go and look at these individual trades. So I'll give you an example in just a sec, but I can see here the CEO is actually selling like 9,708 shares, 9,708, 9,708, 9,708. Okay, so that seems pretty consistent. So just a hunch is that tells me that's to do with his compensation. Like he's not actually selling down his current holding. He's just getting compensated in stock, and he's consistently selling that amount as soon as he receives it. Not necessarily a red flag. It just means like he's receiving his salary and he's also receiving a whole bunch of compensation in stock, and he's selling it as soon as he receives it. So yeah, well, like I said, you can go to the company's investor relations section, and I've got that here. So here's a particular example of one of these trades. So I went to Walmart's investor relations, and then I went to the SEC filings, and this is called the beneficial change of ownership. And I can see here there's the CEO's name, here's the amount of shares that he's selling, and what I mean by getting context is reading this explanation. So I can see here it says this sale was executed pursuant to a Rule 10b-5-1 plan. And if you're not familiar with that, it's basically a pre-arranged sale. So they know in advance, or they announce in advance that, hey, when I receive this stock, I'm going to sell it. So that is a common form of compensation among many executives in the US, and it's just something to keep in mind because they're not basically selling the shares of their own holdings, they're just selling the stock that they're receiving. So still, it's like, it would be great if they held onto it because they like believe that the stock's going to go up more, but it's just a form of them selling. And so I can see here that the Walton family is selling a whole lot more stock than him. So they're selling heaps and heaps here, millions and millions and millions of dollars. But I assume they have a huge holding given it is the Walton family. And yeah, so that's something I'm going to look into as well. Same thing, I can look into what the Walton family is. So I personally don't know, some of you might, what entity that is and why they're selling so much. They seem to be selling pretty consistently, millions of dollars, so they seem to have heaps already. But yeah, there's a few individuals in here as well who've been selling some stock. I will look into those trades as well and see if it's the same 10B 5-1 plan or if it's different to that. So yeah, lots of selling here, and here's the one purchase we saw. But yeah, getting more color on these insider trades, I'll go to the company's investor relations section. And now what I can see here is the ownership breakdown. So I can see private companies are actually the biggest shareholders, which is interesting. That's probably related to the Walton family we're about to see. Institutions own around a third. The general public via the stock market owns around 21%, and then individual insiders and these entities own much, much less. So private companies seem to be the dominant shareholder, followed by institutions and then general public. Good to know that the shares haven't been diluted meaningfully in the past year, which is basically when a management decides to issue more shares. They basically do that because they want to provide funding for new initiatives and stuff. So they have the choice in their capital structure, as we saw above. They can either issue more debt or they can issue more securities. Either way, they raise a bunch of money. The debt could increase risk, whereas the equity increases dilution. So like if you were an existing shareholder and you owned 1% of the company and they issued a whole bunch more shares, your 1% would go down. Which is quite annoying, right, if you're a current shareholder. Good to know that they haven't done that in the past year. Now, this here shows me top shareholders. So I can see here that the top 25 shareholders own almost 2/3 of the company. And as we thought, it's the Walton Enterprises LLC and the Walton family that own almost 46%. And so to get more color on who these private companies are, obviously it's related to the family, I'm going to look into them. I'm going to try and find what the Walton family is. If it's like a foundation, it could be a foundation that's just been selling shares to fund, philanthropic things or something completely different. So I'll try and find out more details about what these enterprises are and just try and understand, like, since they're such a big shareholder, what their kind of power is and what their incentives are as well. So I'll get some more color on them. But followed by them, we saw the institutions are the next biggest shareholders, and that's the likes of the Vanguard Group, BlackRock, State Street, and the likes. So what I look for here is if there's been any large change in their shareholding. So even though we saw all that selling from the Walton family, there was actually only a 5% change of their holdings over the last 2 reporting periods. So not huge, but still like it was consistent. So I'm going to look into why. And then as a percentage of their portfolio, we don't have any data on that, but it shows me how much of these other entities or investors own Walmart as a percentage of their portfolio. So the main thing I look out for is the change, if there's been any drastic buying or any drastic selling. And in this case, there doesn't seem to be anything above 5%. So no, okay, here we go. Someone's added 15% to their position, 7% of their position from these guys. So yeah, some people are actually loading up on the stock, but there's no one considerably selling, which is a good sign. And yeah, so then the last part of the report is company information, if I needed any more context on where it's at and where it's founded and stuff like that. So yeah, that's my first overview of looking at Walmart. And what I basically learned was it doesn't have the best future prospects. Like it's not a high growth company. Like it's had a short-term impact from a one-off item, which makes its current valuation seem a bit elevated. But it seems like the general consensus is that its earnings will improve again. And yeah, so its past performance wasn't that great, but it's highly dictated by that. The valuation was pretty high as well, but that's because of the temporary decline in earnings. But according to Simply Wall Street's valuation model, it seems a bit undervalued. So I'm going to have a look into that and maybe run my own numbers, try what different inputs I can with like different expected growth rates and different discount rates and stuff like that. But I also learned that it's a great dividend payer. It's been consistently increasing the dividend, which is really good to see. It has a low payout ratio on typically about 35% or so. And its balance sheet's pretty good. It's got debt. It's a relatively high amount of debt, but it can afford it in terms of servicing the interest payments, and its operating cash flow, it could pay it off in about 2 years or so. So yeah, next steps is what I would look at is I'm pretty interested in the stock still, so I'm going to add it to my watch list. But next steps would be I'm going to go through and read through those strategy updates that I saw on the share price performance chart, and I'm also going to go and read through those articles that I saw from those pieces in the news and updates section, and go and have a look at those insider transactions that were like related to the selling, and see if there's any reason to be concerned. I don't think there is, just from the little overview I did then, but yeah, I'll go and look into that next. So yeah, that's pretty much an overview of Walmart. Sorry it took so long, but I hope that was very insightful. Thank you so much for watching, and I'll see you next time.